Hey, what's going on, everybody? So today we're here to talk about FICO Score. Well, first off, let's talk about FICO. What FICO actually stands for is the Fair Isaac Corporation. And what the Fair Isaac Corporation is, it's a company that basically tracks your credit worthiness. So they get their information from the three credit bureaus, which are TransUnion, Equifax, and Experian. And FICO pretty much takes an average of those three credit bureau scores and they make up your FICO score. So your FICO score pretty much determines your credit worthiness as a borrower. So let's talk about the things that actually build that score. So, even though that FICO is getting these credit scores from these three credit bureaus, let's talk about the things that these credit bureaus actually take into account when they are coming up with a credit score for you. The first and most important thing that accounts for 35% of what makes up your credit score is payment history. And now payment history is very important as a borrower, because if other lenders are looking at you as a person that they're considered lending to and they see you have a bad payment history, they're more likely not to lend to you. Because think about it, if you were lending somebody money, wouldn't you want to see their history as a borrower from other people? And if they had a bad history, would you want to let them borrow your money? I didn't think so, me either. So before we talk about the next factor, if you are new to my channel, welcome to my channel, Limitless NYC. My channel is about my path to financial freedom, and my path consists of real estate investing, stock market investing, as well as doing side hustles, ways to save money, ways to make money, and pretty much the journey as a whole. And in that journey, there is some fun included. So if you are new, make sure you smash that like button. Make sure you hit the subscribe button so you can get up to date with all my videos and whenever they come out. Hit that notification bell so you are notified whenever a new video comes out. But all right, let's move on. The next major contributing factor to your FICO score or your credit score is the amounts you owe, which is pretty much your credit utilization. So this contributes for another 30% of how your credit score is built up. So amounts owed is pretty much, let's say you have a credit card and your credit limit is $1,000 and you are using $900 of that $1,000. So at this point, your credit utilization is 90% and your amounts owed would be considered at 90%. So as a lender, they're not looking at you very credit worthy, because of course, as a lender, to see someone who is using 90% of what someone else let them borrow, it just makes them look bad because they're not being very responsible. So typically the best utilization rate is at least under 30%. So if you have a $1,000 credit limit, you should be at $300 or less. And ideally, to even have a better credit score, you would want to keep it under 10% to make you look the most financially responsible. So pretty much payment history and your amounts owed contribute for 65% of your credit score. So think about how important that is. I don't know about you guys, where I went to school, 65 is passing, but that's not all. We don't want 65s. We don't want to barely pass. We want to score 100. So to score that 100, the next thing you have to look at is your length of credit history. So that contributes for 15% of your FICO score or your credit score. Length of credit history is important, but it's obviously not as important as the other things. But, anybody who is letting someone borrow money, they want to see that they have a track history of paying back the people that they borrowed money from, aka paying back the banks. So the longer your credit history is, obviously the better you look as a borrower, and in the eyes of the banks, in the eyes of FICO, and pretty much your credit score will reflect. So if you watch the video and you like, make sure you do the subscribing, make sure you do the liking of the video, and also thank you, come again. Okay. And now the next thing is credit mix. So this contributes for 10%. And what I mean by credit mix is having a mixed variety of credit that you have. Let's say, for example, you only have credit cards. So the only thing on your credit report is you just having credit cards. So in order for you to mix that up, let's say you're buying a car and you get a car loan. Now you have a little bit more of a mix. Let's say you're buying a house and now you have a real estate loan. Now you have more of a mix. So obviously, if someone who is qualifying for these bigger purchases such as cars and homes, they are obviously more credit worthy than someone who doesn't doesn't have a mix of these, because now they look at you as this person is only pretty much getting credit cards. So having a mix of credit contributes for another 10%. So the last 10% comes down to new credit. New credit is pretty much being able to secure new forms of credit, because the more credit you have, the easier it will be to keep your utilization down. Because if you only have one credit with $1,000 max limit, getting new forms of credit will make it easier for you to keep your credit utilization down, aka the amounts owed, and that contributes for 30%. So when you open up a new credit, let's say for example, you do have that $1,000 credit limit credit card, and you did spend $900 of that $1,000. So now you're at 90%. Now let's say you open up a second credit card, which gives you a $5,000 limit, because they saw that you've been paying off your first credit card, so why not give you more money? So now you have a $5,000 credit limit credit card, and you also have that $1,000 credit card that you originally had. But now because you have two, your total credit is at $6,000 instead of $1,000. So even though you spent $900 on that first credit card, your credit utilization is actually lower now, because you have a total of $6,000 instead of $1,000. So you're only using $900 out of your $6,000 instead of $900 out of your $1,000. So therefore, you obviously will have a lower utilization. All right, guys, I hope this video helped you guys. And if it did, please do subscribe to my channel. Please like this video, and let me know if you have any comments or any questions in the description about credit or anything else in general. And hit that notification bell so you are notified every time I post a new video. Just so you know, I'm not playing. Hit the subscribe button.